Hey guys, what's going on? Jeb here, and in today's video, we are going to be talking about the major corrective movement that Bitcoin just underwent, and I'm going to show you exactly why it is happening. This has to do with a number of different factors. It has to do with the rally that we're seeing in the United States S&P 500 right now. It has to do with the rally that we are seeing in the gold market right now, but most importantly, it has to do with the rate cut that we saw last week from the Fed and the two rate cuts that we are going to expect coming, and the fact that the 10-year treasury bond actually went up rather than went down when we saw the rate cut. We're going to break down all of this and more. And by the end of this episode, you're going to understand why Bitcoin just corrected and why it's actually a massive bullish setup that is going to help Bitcoin go into the final leg of this bull market. So without much further ado, let's go ahead and dive right on into it. I appreciate you guys being here. You'll have to forgive my raspy voice. I'm quite sick. You know how having young kids is. They love to share everything with you, especially their germs. And so my voice might be a little bit more radio-y. There we go. I'm ready for my radio appearance. All right, let's do it. We've got a lot to cover. First thing we want to talk about is Bitcoin. Bitcoin over the weekend has dropped all the way down to about 112,000. What essentially happened here is we saw a massive liquidity grab where Bitcoin dumped down and liquidated a ton of longs. A lot of people were not expecting Bitcoin to have one last corrective movement before we start heading back towards all-time high. And so what you ended up seeing happen was a large number of liquidations take place on Bitcoin over the weekend. This liquidation actually ended up being to the tune of several $100 million. This is one of the largest long liquidations that we have seen in this year so far. In fact, yesterday, it was a $1.5 billion long liquidation. This is the largest long liquidation that Bitcoin has seen in a very long time by a huge margin. And so this is the first thing we need to talk about, is that massive, absolutely enormous long liquidation did not drop Bitcoin below 112. That's very exciting. That just goes to show you how much buying pressure is in this area. All right, so let's start with the charts and then we'll move on to the fundamentals. The first thing I want to point out here is that Bitcoin is in the process of building a massive inverse head and shoulders pattern. We have discussed the possibility of a right shoulder forming, and it does not invalidate our hypothesis that Bitcoin will be rallying up to $130,000 by October the 15th. Our first prediction of Bitcoin going to $118,000 by September the 17th occurred perfectly. That is exactly where we hit. I am now expecting, and I still expect at this point in time, that Bitcoin will be rallying up to 130, if not higher, by October the 15th. And a large part of that has to do with the fact that all those longs just got wiped out. People are building new positions. The bears have had their day. People have taken profits. Bitcoin had this uptrending level of support right here, which broke. And as soon as it broke, we had a major crash, because any of you guys who have been watching us trade or other traders know that when you break the safety line, which we had right here, that's where you put your stop. Everybody got stopped out and liquidated right here because they were expecting us to rally straight to all-time high because of the rate cut. But as we've discussed on this channel, rate cuts are not so simple. Oftentimes, rate cuts are extremely good for Bitcoin in the long term, but in the short term, they can actually drive a correction. And that's what we saw happen. We had a buy the rumor, sell the news kind of event where Bitcoin rallied up and until the rate cut. And after the rate cut, Bitcoin ended up going into this major corrective movement. This is part of the reason that you need to be very careful about trading the Fed decisions, because they can throw a wrench in all of your plans. Now, one thing I also want to mention here is that Bitcoin did stop here at the 0.618 Fibonacci retracement level when you draw a retracement from 124,500 down to our local bottom of 107. The reason that this is concerning is because this theoretically would indicate that this correction here could be the third wave of an Elliott wave, 1, 2, 3, 4, 5 wave. They could send Bitcoin down like as low as $100,000, for example. Do I think that's going to happen? No, at this point in time, I do not think that that's going to happen. However, what I am looking for right now is to see if Bitcoin is able to put in a higher low than 107. If Bitcoin breaks $107,000, then that means all bets are off and we're going down to 100. So that would be one of the invalidation levels you're going to want to keep an eye on over the course of the next couple of weeks, is that if we do drop down to 107, if that breaks, $100,000 is basically a foregone conclusion at that point in time. I, however, am not very much convinced that that's going to happen right now. I think that this is not a third primary wave move forming, and that everything that just happened was a bear flag, which would look something like this. No, instead, what I think is happening is that Bitcoin is backtesting this zone right here between 112 and 113, where it will then build momentum and be able to rally. I expect these to look like excellent buying opportunities when you fast forward a month from now until that is invalidated. I would not be expecting major bearishness until this longer-term uptrending level of support right here would be broken. That would have to result from a Bitcoin drop below 110,000. Now, why did we drop? You will have to forgive me. I sound a little bit like I sound a little bit funny right now. Feel free to make fun of me in the comments. It's okay, guys. This is like the 7,000th piece of content I put on the channel. It is not the first time I've been sick on air, but we got to do it. We got to keep on moving. Why did this correction happen? Well, it happened very simply because the Fed cut rates. And when the Fed cut rates, we expected that something called the 10-year treasury would drop, but instead it didn't. I'm going to have to give you a little bit of an economics lesson here. When the Fed cuts rates, generally speaking, you expect the 10-year treasury bond to drop because debt just got cheaper, so people are willing to accept a lower interest rate on the treasury bonds. This makes sense because the treasury bond is very much upstream from the effective federal funds rate, as it is a debt instrument that helps the United States federal government to function. The effective federal funds rate is what is also known as the base rate, and basically every single other interest rate in the United States economy is based on the base rate. And so when the base rate goes down, you expect all of the other rates that are based on the base rate to go down as well. That is not what happened. And that's because this is actually a dichotomous relationship. All of the other interest rates in the markets are not only impacted by the effective federal funds rate, the base rate, they are also impacted by people's confidence in the United States dollar. It's very interesting that we saw a major correction, a major drop in the US 10-year bond rate. And then when the actual announcement came that we were seeing a rate cut, it rallied, it went up. This is because Jerome Powell basically admitted that the United States is going into something called stagflation. He didn't use the term, but we need to talk about it because it's very important. And it's something that is going to help us to understand where Bitcoin is going, why the short-term effects of this are going to be bearish, but the long-term effects are actually very much in favor of Bitcoin. So the United States Federal Reserve has something called a dual mandate. They have a mandate to keep inflation under control. This is called, price control, more or less. And they also have a mandate to keep unemployment low. The issue with stagflation is that you have high inflation that is uncontrolled and you have high unemployment. Well, the effective federal funds rate is the primary tool that, along with quantitative easing and tightening, that kind of completes the major tool belt that the Fed has. And so these tools are only really effective at controlling one or the other at a time. If you increase the effective federal funds rate, then you can help to bring down inflation. Theoretically, that's the way it goes anyway. On the other hand, if you raise interest rates, you can also end up lowering employment because all of a sudden businesses don't have access to cheap capital that they can then use to go and hire new people and take more risks because they're paying less money in interest. And so what you see happen when stagflation occurs is that the Fed is essentially powerless to do anything about either, and it enters into this gridlock where you have poor employment data, and you also have poor economic data from the standpoint of inflation. And so this stagflation that Jerome Powell admitted to during the press conference last Wednesday is exactly why the 10-year bond went up. And the reason that the 10-year bond going up matters is because it freaks people out. The 10-year bond is supposed to go down. It's like clockwork. It's almost guaranteed to go down when the effective federal funds rate is cut. But the fact that it went up scares the living crap out of people because it means that all of a sudden, the investing public's fear over the strength of the United States dollar is now greater than the Federal Reserve's ability to control interest rates. I want to let that sink in for just a second, right? I'll open the door, sink and walk in, right? I want that to sink in. The United States investing public is more afraid of inflation than they are confident in the Fed. Now, we're in an echo chamber here in Bitcoin. Nobody trusts the Fed as far as they can throw them, and the Fed's a pretty big entity, so you can't throw them anyway. But that's in crypto. Believe it or not, most of the public still trusts the Fed, which is loco, right? They've been teaching it as economic policy for 100 years in the universities. It's indoctrination in its purest form. So that's changing. And so with the effective federal funds rate being cut, the fact that the interest rates are going up on the 10-year bond and mortgage rates jumped as well leads people to this conclusion. Or actually, it's not leading people to this conclusion. It's evident that people have already come to the conclusion that they cannot trust the Fed and that they cannot trust inflation to get under control. You see, the reason that the interest rate on the 10-year bond goes up is because people don't trust U.S. treasuries, and so they demand a higher rate. Just for the basics here, a treasury bond is a form of credit that the United States government issues to the investing public so that they are able to raise capital to fund the deficit spending at the federal level, at the congressional and the federal level, at the Treasury. And so the less confident that people are in, the less confident that the investing public is in the United States government's ability to repay the debt, the higher the interest rate they're going to demand. And so when you saw the Fed cut rates and basically give up on Target 2 last week, that causes people to demand a higher interest rate. This movement right here is evidence that the United States investing public is terrified of the United States debt, and they don't trust that the federal government has any ability to do anything about it. Let me say that again. The United States investing public has proven through this increase in the rate on the 10-year that they no longer trust the Fed to be able to get inflation under control, and they're freaked out about the debt. Now, here's where we're going to tie all this back into Bitcoin. If you've been patient with me, you're about to get a really huge payoff. If you already clicked out, I'm sorry. Why does this matter for Bitcoin? In the short term, when the investing public is terrified of the United States federal deficit, the debt, and they lose faith in the Fed. Again, we're in an echo chamber, but the majority of the money out there, they do one of two things. They buy gold or they buy the stock market because they believe that they are safe havens. They believe that investing in the economy allows them to invest in something that eats inflation like it's breakfast and then just chugs right on along after it. So they buy the stock market. This is why the United States S&P 500 is still performing very well after this rate cut, because we have one rate cut and we have basically a guarantee of at least two more. We expect that we're going to see another 2 rate cuts at both meetings, one at each meeting for the rest of this year, and then probably more leading into the following year. And so that's why the S&P 500 is on this massive rally. It's also why gold is on this massive rally, because the traditional people say, I need to buy stocks. Can't trust cash, can't trust treasuries. I'm going to rebalance my portfolio away from treasuries into stocks. People that have a little bit more sense about them understand, okay, that means I can't, if the Fed is not able to get the interest rates down at the bond level, at the US Treasury bond level, then that means I can't trust the entire government. I can't trust the systems and the powers that be, so I'm going to buy gold. But both parties are risk averse. And so that risk averse nature is leading them to what they know best. The gold bugs are buying gold, and everybody else is buying stocks. And this is leading Bitcoin, and this is where we get to our conclusion about what's going on with Bitcoin. This leaves Bitcoin a little bit up a creek because Bitcoin has still not yet been formally mass adopted as the hedge against government tyranny when it comes to finance and inflation. And it's going to take time. Somebody ought to sound bite, clip what I'm saying, make fun of me a little bit. It's going to take time for people to be able to understand that gold and the stock market are not the safe havens you think they are. But instead, Bitcoin is. In the short term, this means that attention is off of Bitcoin for the near term. In the long term, this is actually a very good thing for Bitcoin because as the dollar dies, value will flow into Bitcoin like crazy. Bitcoin is moving very rapidly into the direction of being a safe haven asset that people consider to be something like gold, and it will eventually eat the gold market and eat the S&P 500. And it's also very much undervalued right now, which leads us to the conclusion that this short-term correction is something that will not last. It is something that we will see come to a conclusion, and it is something that I believe over the next few months will help us actually to go back to all-time high and well beyond. At the end of the day, what I believe is going on right now is a careful and delicate dance between the investors, the Fed, and the government. And at the end of the day, just about everything that the Fed and the U.S. government does, whether they do one thing or the opposite, is leading the investing public to trust them less and less and less. This leads to instability in markets, which leads people away from investing in what they would consider risk-on assets like Bitcoin. But for those of us that are in Bitcoin and see what's coming in 10 years, it only solidifies our resolve to acquire as much Bitcoin as we possibly can. If you enjoyed today's video, make sure to hit that like button, subscribe to the channel, make sure to check out StampSeed, keep your seed phrases safe. And before I go, I do just first want to thank each and every single last one of you for watching as always, and I will see you guys in the next video. Peace.